Welcome to the Week in YouTube Finance. Let's get into it.
What's up, Graham? It's Guys here, and if you've ever wondered how much money I make, here you go. A few weeks ago, Shelby Church posted this video about what does better, 5 years in stocks versus 5 years in real estate. Honestly, after watching her video and seeing some of her really shocking numbers, I was inspired to look through my own portfolio to see exactly how much I've made in stocks versus real estate, how they compare, and what this means for the average person watching. Because I have a feeling it's probably not what you're expecting. And if I could save a few people from making a really big mistake, then this entire video is 100% worth it. Although before we start, as usual, if you appreciate videos like this, all I ask for in return is that you hit the like button or subscribe. Plus, I'm going to be linking to Shelby's video down below in the description for anyone who wants to follow along. So thanks so much, and also a big thank you to Public.com for sponsoring today's video, but more on that later. Alright, so first, let's talk about how much money I've made from real estate. I hate to say it, but for most people, this is going to be completely dependent on when and where you bought your home. Because as you're about to see, you could either make a ton of money or you're going to be completely fucked. In my case, the first property I purchased was back in 2012 as a bank-owned foreclosure in San Bernardino County for $59,500. Yeah, seriously. I bought it outright in cash with money that I had saved up for 4 years working as a real estate agent. I then spent another $12,000 fixing it up, and it's currently worth about $400,000, while earning about $1,500 in net rental income every single month. From there were 2 other properties that I bought and recently sold with nearly identical returns. And over the years, I just kept saving up my money until 2016, where I bought another property in West Los Angeles for $780,000. In terms of numbers, I was able to buy it with about $150,000 down, and I got a 30-year fixed-rate mortgage at 3.375%, and then I spent another $60,000 fixing it up. As a result of that, I made about a 280% return on my money, while also earning about $150,000 in rental income over the last 5 years. From there, though, the returns do get a little bit more difficult to calculate. For instance, in 2017, I purchased a duplex in mid-city Los Angeles for $585,000. I've spent a total of $220,000 fixing up both units, and now I'd say it's currently worth about $1.2 million. But in 2018, I was able to do a cash-out refinance to pull out all of my initial investment while locking in a 30-year mortgage at 3.75%. This means I have none of my own money in the deal, the upside is pure profit, and I've made about $120,000 in rents since 2020. I also did something similar with another duplex that was located down the street. I bought it for $815,000, I put 15% down, and I later rented it out, and now it's worth about $1,150,000. When you add all of this up, purely from an investment standpoint, with properties that were purchased to renovate and later rent out, I have $643,000 of my own money invested for a total value increase of $1,843,000, which equates to a 281% return, not including any rental income. But keep in mind, all of this was over the last 10 years, so how have they done over the last 5 years? Well, here's where things get interesting. Despite what you might think, my home values in Los Angeles County did not see that much appreciation over the last few years. I mean, sure, values certainly did go a bit higher, but it's probably not as much as you would expect. For instance, my first home was worth roughly $300,000 before COVID, and now it's worth about $400,000 5 years later, for a 33% total increase. The second property was worth about $1.2 million before COVID, and now it's worth about $1.4, a 16% increase over 5 years. The third property, a duplex, was worth about $1 million before COVID, and now it's worth about $1.2, a 20% return, and the last duplex was worth about $950,000 before COVID, and now it's worth $1,150,000, which is a similar 20% return over 5 years. Now sure, I was able to collect rental income on top of this, but I'm also very fortunate to have locked in record low mortgage rates at a record low property tax basis with low down payments. And I'll be honest, if I didn't have all of these factors working in my favor, I just don't think it would have been sustainable. I mean, just consider this. Over the last few years, my home insurance rates have gone up about 35 to 40%. My property taxes have gone up about 15%. My labor and material cost has gone up 50 to 100%. And if I were to buy any of these properties today, I would be losing a substantial amount of money. Like, let's take the example of my first property. If you bought that today at $380,000, you'd put 15% down and get a 30-year fixed-rate loan at 7%. Your monthly payment would be $2,148 a month, which is already significantly higher than what I'm getting in rent. But on top of that, you would also have property taxes at $375 a month, home insurance at $125 a month, and repairs and maintenance at $150 a month. All of a sudden, you're now spending $2,900 a month for a property that you could rent for $1,950 a month. So even though real estate has been a really good investment, at today's prices, the numbers just don't pencil out. Although with stocks also at record highs, how much would I have made had I just thrown it all in an index fund instead? Alright, so in terms of how much money I made in stocks versus real estate, here's what you came for. Overall, on any deals that were purchased on or before 2018, the real estate investments actually outperformed the stock market by about 20 to 50%, not including rents. Normally, I just go over each of these one by one, but because I'm really worried it's going to be a long-winded analysis and some people are going to get bored and click off, I'm just going to put it on the screen here and you can pause the video if you want to break it down. Anyway, for anything purchased on or after 2020, things are a bit mixed. For example, I bought a home in West Los Angeles that underperformed the stock market by about 35%, but my purchase in Las Vegas overperformed the markets by about 100%. Basically, the stock market has been on an absolute tear since COVID, and even when you account for low down payments and low mortgage rates, stocks overall still did better. Although for anything purchased on or after 2021, the real estate winner effect tends to make a lot less sense. Look, as someone who's worked full-time in real estate since 2008, I'm the type to carefully look over the numbers, look at the risk of any deal, and then compare that to every other investment that I could possibly make. And even though real estate made a lot of sense when interest rates were low, once prices started skyrocketing and interest rates rose, I started pulling back and invested my money in index funds instead. The reality is, nationally, home prices have risen 47% since the start of the pandemic, during a time when the stock market has risen 124%. So is this then confirmed that stocks have been better? Well, it really just depends on how you look at the data. In this case, most people aren't buying their homes outright in cash, and instead they're getting a loan from the bank for the difference, meaning for every $20,000 they put down, they could get a loan for $80,000. This is why for the average person who bought their home in 2020 with 20% down, their initial down payment has increased in value by 235%. And if that sounds confusing, just consider this. Let's just say you buy a $100,000 home with an $80,000 loan for $20,000 down. Now 5 years later, the home is worth $147,000. This means your $20,000 investment is now worth $67,000, allowing you to have tripled your down payment. Of course, there are other aspects to consider, like the interest rate on the $80,000 loan, property taxes, insurance, and repairs, which probably amount to an additional 7 to 8% a year of total value, but the point still remains. Leveraged real estate at a sub 4% interest rate purchased before 2020 has so far outperformed the stock market by a very wide margin in most areas. However, more recently, things aren't looking as good. For example, if you bought a home in 2022 with a 6.5% interest rate, the cost of borrowing money just becomes too high to offset the benefits of leverage. Like, just take this as an example. You buy a $100,000 home, $20,000 down with an $80,000 loan at 6.5%. Even though the market has gone up by an average of 5% a year during that time frame, you're paying 6.5% for the cost of keeping a mortgage, completely wiping out nearly all of the benefit of home appreciation. So unless your area sees home appreciation above 8% a year, your best case scenario is simply a break even from an investment standpoint. Now, on the other side of the coin, you have index funds. Over the last 100 years, the S&P 500 has averaged a 10.6% annualized return with dividends reinvested, which is pretty good for basically no work. This means instead of putting 20% down on a property with a 6.5% mortgage rate that historically appreciates 4% a year, you could potentially make an average of 10% with just a click of a button. As an example of this, let's just say you have $100,000 to invest, and you want to know what's going to make you more money over 20 years, housing or an index fund. Well, an index fund is going to be really easy. At a compound annual growth rate of 10.6%, after 20 years, your $100,000 is going to be worth $750,000 with dividends reinvested. But with real estate, you could use that $100,000 as a down payment on a $500,000 property at a 6.5% mortgage rate. This means your overhead cost is going to be $2,550 a month for a mortgage, $500 a month for property tax, $200 a month for insurance, and another $300 a month for miscellaneous repairs and maintenance, for a total cost of $3,550 a month. In my market, a home like this would probably rent for around $3,500 a month, which means you're going to be losing about $50 a month in cash flow. But you would be paying down the mortgage by an average of $375 a month in the first year, giving you a total profit of $325 a month, plus home appreciation. But it doesn't quite end there. According to the National Association of Realtors, the median single-family home appreciated by an average of 3.92% a year, meaning over 20 years, your $500,000 home is going to be worth $1,078,000. So housing wins, right? Not so fast. Over 20 years, you will have paid down your mortgage balance to $206,000. If rents stay consistent with the increases in property taxes, insurance, and repairs, your net amount will stay the same. And when all is said and done, your $100,000 investment over 20 years will have grown to $872,000. Although, in order to do this, you're required to keep a tenant at all times, keep all repairs and maintenance under $300 a month, and literally have zero downtime whatsoever for any vacancy, which I gotta say is literally impossible. More than likely, over the long term, you're going to have an average of 1 month of vacancy every 16 months for a time where a tenant moves out and you have to get it re-rented. This means you're going to lose out on $52,000 worth of rental income over 20 years, bringing your total return down to $820,000. Then subtract any large one-time costs from non-paying tenants, large repairs, or any renovations you have to do, and all of a sudden, leveraged real estate is pretty much the exact same return you would have made in the stock market, except with a lot more work. However, let's be real, from an investment standpoint, unless you're specifically out there trying to find undervalued real estate that you could fix up at a favorable mortgage rate in a landlord-friendly city, at best, most homes are simply just a hedge against inflation and a roof over your head. That's it. The way I see it, if you're looking for a place that you could move into yourself, that you love, that you intend on living in for at least a decade, then yes, buying a house could be a great financial decision. But in the short term, at least at today's prices and mortgage rates, investing in other assets like stocks seems like it'll make you more money, even though it can be more volatile. But besides that, on a human level, I will admit that there is something to be said about owning a property that is completely yours, where no one can tell you what to do, and no one's going to be jacking up your prices the next year. Even though that's what insurance companies and county assessors love doing, but that's besides the point. This is why it's really hard to compare a home that you'll live in with the opportunity cost of investing in anything else, because at the end of the day, you're going to need a place to live. At that point, it's really just a matter of crunching the numbers to determine if it's better to rent or buy right now. And I've made quite a few videos on this already that I'll link to down below in the description. Although in terms of buying rental properties versus investing in the stock market, for me, I just haven't seen many opportunities after 2020. And I'm much happier just throwing it all in an index fund and letting it do the heavy lifting for me. Look, what I'm really trying to get at here is that I'm only able to run a profitable rental business because a lot of these properties were purchased at a fairly low price almost a decade ago, financed with really cheap debt that's locked in over the next 30 years. At today's prices, none of this would be feasible. Nothing would cash flow. And when the conditions aren't right, it's just I wouldn't be able to do it today. Yes, I'm sure deals still exist in certain markets, but they require a lot of work to find, renovate, and manage. And when I look at all the work involved in that, index funds, dollar for dollar, just seem like a better option. Housing can be a good investment, but it's not automatically an investment by default, unless you go into it intentionally trying to make money. But even then, it's difficult to compare one-to-one because you gotta live somewhere. There's also a chance that your market where you buy real estate appreciates faster than the national average, which is the case for about 50% of properties. So you could make a lot more money than what I outlined here. Personally, I tend to believe that when it comes to real estate, you make the majority of your money when you buy, and not necessarily when you sell. and you can't quite make a dollar-to-dollar comparison because there is an emotional aspect to owning real estate that you can't put a price on. But it is worth saying that housing isn't always a good investment. It's worth diversifying into other assets just so you don't go all in on one thing. Real estate can be a lot of work compared to other options like owning an index fund, and no matter what. If you found this helpful, make sure to hit the like button and subscribe if you haven't done that already. Thank you so much for watching.
Well, awesome. Thank you, Graham. Let's see who we got next.
What if the United States, Mexico, and Canada became one country? If all three nations joined together to form a single country, they could call it COM, or the United Nations of COM, and it would instantly become the most powerful country in the world. Economically, this union would...
That's enough internet for today. Recently, Mr. Donald Trump proposed a 25% tariff on Canadian and Mexican goods. And what's even more interesting is that he mentioned making Canada the 51st state of the US and potentially buying the Panama Canal and acquiring Greenland. Now the question is this a real plan or is this all just a joke? Now, to understand what's going on, I want to explain some of the political and economic backgrounds of what tariffs are and how we've used them in the past, and this will help explain why Mr. Trump is thinking of doing all of this. Now, a tariff is essentially a tax on imported goods. When a country imposes a tariff, it makes international products more expensive. Now, the idea is to get people to buy products made in the home country instead, which can protect local industries and jobs. So for example, if the US places a 25% tariff on Canadian lumber, American companies that buy Canadian lumber would have to pay an extra 25% on top of their original price. And that might discourage them from doing so in the future. Now historically though, that was the main way the United States used to make money. Before the introduction of income taxes in 1913, the federal government was almost exclusively funded through tariffs. And during the 18th and 19th centuries, tariffs not only paid for government operations, but they played a huge role in forming the country's economy by protecting startup industries from foreign competition. And that's where we're gonna start. So let me explain Donald Trump's ultimate design, what he wants to do, why he wants to do it, and show you how this might affect all of us. So let's get into it. Hi, my name is Andre Jick. Hope you're doing well. Come for the finance and stay for the tariffs. This video topic kind of reminds me of those essays I had to write about in school, and I always thought there was such a dry and boring thing to talk about. So I'm gonna try to make this video exactly like those essays, with a 5,000 word minimum. So here's how I like to think about all of this. Mr. Trump wants to help the US economy grow. And one of the ways he wants to do that is through expansion and the use of tariffs. Now, most people, when they think of the United States and its rise to power, they think about the American dream and individualism and businesses and innovation, but there's another less glamorous part of US history that played a really big role in how the country got here: tariffs. In the late 18th and 19th centuries, for example, the United States was the economic equivalent of
"You've got mail."
AOL. It was a tech startup, and the country was competing with huge corporate giants like Britain, and their industrial machinery and advanced economies just dominated global trade. So for the US to grow, it needed a strategy to help its younger industries, and that's where tariffs came in. This also was one of the founding fathers' dream. It was Alexander Hamilton's vision for the United States when he published a report called Manufactures. Now, the earliest example, the first tariff the US ever imposed, was started on July 4th, 1789. And the idea was that any imported goods into the US would have what's called a duty rate, on average between 5 to 15%. And usually things that were needed, like raw materials, would have the lower 5% rate, and luxury items that were not needed, like cheese or wine, would be taxed at the higher 15% rate. Now this created a huge source of income for the country back when the federal government didn't really have any income taxes. Now, other examples of tariffs were protective tariffs like the Tariff of 1816, which was designed to also shield American manufacturers from cheaper British goods. And all these tariffs had the effect of growing industries in the northern US, like the textile industry, steel, and machinery. But on the flip side, it harmed southern US industries, like farmers and agriculture, because they relied on exporting their goods to foreign markets and importing manufactured products, which also became more expensive due to the tariffs. So, long story short, tariffs did three important things. Number one, they gave the US a reliable source of income to pay off war debts from the Revolutionary War. Number two, it helped fund the federal government and everything it was spending money on. And number three, it protected jobs and industries. That's what tariffs do. That's what they are. They are neither good or bad. It just depends on what they are and how they are created. But there's also kind of a catch. And the catch is that tariffs work both ways. Because countries are like people, they can be petty too. So when you put restrictions on their trade, they tend to do it back. Now, in the modern era, today, countries like Canada, Mexico, and China have imposed their own tariffs on American goods. And here's what they're doing and how much it's costing the US. I'm going to use three examples: Canada, Mexico, and China. For example, when the Trump administration imposed tariffs on Canadian aluminum and steel in 2018, Canada said, well, then we're just going to put tariffs on US products like ketchup, whiskey, and motorboats, because that's all we buy from you guys. Now, example two is Mexico. And you've probably seen those awkward exchanges between the US and Mexico because there are tensions.
I'm not going to pay for that wall. He should pay for it. He's got the money.
And that's because Mexico has imposed tariffs on American agricultural products, including pork, apples, cheese, also in response to US steel and aluminum tariffs. As you can tell, we source a lot of our steel and aluminum from other countries. And this directly impacts American farmers and ranchers who really depend on Mexico as an export market. Now, example three, though, is China. And China is the US's biggest trading partner. China's also used Mexico to get around US tariffs, and it uses its own tariffs against the US. There are tariffs as high as 25% on American products like soybeans, cars, and even lobsters, which lowers the demand for these products in the Chinese market, because Chinese people don't want to buy American products if they're too expensive. Our lobsters are good, but they're not that good. And all of this has led to billions of dollars in losses. Now, how much specifically, though? Here are some of the estimates of how much this is costing the United States economy. According to the Congressional Budget Office and various trade reports, U.S. exporters pay billions of dollars per year in tariffs to other countries. U.S. exporters paid over $35 billion in what are called retaliatory tariffs during the height of the trade war to China. So Donald Trump comes in, looks at all this and says, okay, we're paying billions of dollars to trade with these countries, even though we help and support these countries in many ways. And he feels like the United States is a lot more fair to them than they are to us. And that's where Donald Trump's plan to fix all of this comes in. Now let's take a step back to Mr. Trump's first term in 2017. That year, the US stock market did really well. The S&P 500 went up over 19%, but since 1993, during the first year of a president's term, the stock market has averaged gains of about 16%, with some years hitting as high as 31%. Donald Trump is proposing an additional 10% tariff on all Chinese goods and another 25% tariff on all products from Mexico and Canada.
Some might say it's economic nationalism. I call it common sense. I call it America first.
Now, right now, according to data from the Census Bureau, Americans spend more than $1 trillion on goods from those three countries each year, which means the US could potentially make a lot of money from these tariffs. But there's another reason why tariffs are actually created, and it has nothing to do with making money. Instead, it's more of a pressure point for those countries to do something about problems that are spilling over into the US. And there's two main issues that Mr. Trump ran on for president that helped him win: illegal immigration and drug trafficking.
And drugs are pouring in. Almost as importantly, drugs are pouring in, maybe more importantly.
Now, Mr. Trump argues that both countries, Mexico and Canada, need to take more responsibility for preventing these problems from spilling over into the United States. Illegal crossings, for example, at the US-Canada border have surged dramatically in recent years. From 2021 to 2024, there was a huge increase. And while these numbers are small compared at the US-Mexico border, it's still a growing problem. The Swanton sector, for example, which covers part of Quebec, Vermont, and New York, has become a hotspot with reports of organized smuggling networks exploiting Canada's huge but very lightly patrolled border. And this increase also points to the northern border becoming an alternative route for immigrants seeking entry into the US illegally. And in 2024, US border agents seized 43 pounds of fentanyl, 72 pounds of heroin, and 185 pounds of methamphetamine crossing from Canada. And while it's true that these amounts are way smaller than what's intercepted at the southern border, experts believe that's because Canadian ports limit their inspections to only about 1% of incoming containers. And that makes it way easier for things to slip through unnoticed and report these smaller numbers. This creates vulnerabilities in the supply chain, and it allows for organized crime networks to exploit gaps in enforcement. And by creating these tariffs, Mr. Trump is telling Canada and Mexico, hey, if you don't want to pay more for US products, fix your borders, control your crime, and keep the illegal immigrants out of the US. So now that I've hopefully explained the background behind how the world is positioned, this will help answer the ultimate question of this video, which is, how does making Canada the 51st state, getting the Panama Canal, and buying Greenland have anything to do with this? And here's why this has everything to do with tariffs. Because tariffs are a way for Mr. Trump to tell the world he's putting America first again. And those tariffs are just a starting point in negotiating better terms for the United States. So let me start with Greenland, the place that most people think is actually Iceland, but is really Greenland. Now, fun fact, Greenland is a territory within the Kingdom of Denmark, which means it has significant self-rule, but it's actually under Denmark's official legal structure. But why Greenland is because Greenland has huge reserves of rare earth minerals, natural gas, and oil. And that means Greenland may need more freedom soon. Now, Greenland has a strategic position in the Arctic, which, in the eyes of the United States, makes it a valuable asset for national security and economic interests. And control over Greenland could give the US an advantage in Arctic navigation, especially as global warming will eventually open new shipping routes. And believe it or not, this idea of the US buying Greenland isn't even new. Because in 1946, President Harry Truman at the time offered Denmark $100 million worth of gold in exchange for Greenland, which is equivalent to about 1.3 billion in today's dollars when adjusted for inflation. Now, in 2019, during his first presidency, Mr. Trump said that he wanted to buy Greenland, but he never made any formal offers, at least not one the public knows about. But at the time, there were estimates that Greenland could be valued in the range of between 500 billion to 1 trillion. But at least for now, both Denmark and Greenland are strongly disagreeing and saying that Greenland is not for sale. Then, of course, there's the Panama Canal. The Panama Canal is one of the most important trade routes in the world, connecting over 140 routes and accounts for about 6% of global trade. That's huge. Its strategic location between the Atlantic and Pacific Oceans has made it a very big interest for the United States. And for almost 100 years, the US controlled the canal and the surrounding canal zone. And the US, in fact, used to own the Panama Canal. The US gained control of it in 1904 when it bought the project from the French for $40 million. And it negotiated a deal with Panama for an additional $10 million up front and $250,000 per year, which of course at the time was a lot of money. But you can see how over the course of 100 years, how inflation has eaten away at that money's value. And by 1914, after about a decade of work, the canal opened and it revolutionized trading for the western part of the world. But for the US, it wasn't just about trade, it was also about its military strategy, which allowed the US to move through it really quickly. But it also came at a cost. Even though the canal helped with America's interests, it created resentment in Panama. This resentment eventually led to negotiations, which led to something called the Torrijos-Carter Treaties of 1977, which promised Panama that it would assume full control of the canal by December 31st, 1999. Today, the canal generates billions of dollars worth of revenue for Panama, and it's the most important trade route for the western part of the world. And that's why Mr. Trump wants it back. And then of course there's Canada potentially becoming the 51st state of the US. Now Canada is the second biggest trading partner for the US, with what's called bilateral trade amounting to over $600 billion per year. That means every single day, about $1.7 billion worth of stuff and services crosses the US-Canada border. Now, by making Canada the 51st state, Mr. Trump's vision could get rid of barriers and tariffs, creating a huge, unified North American economy. Now, the US already imports about 60% of Canada's oil production, making it the top foreign supplier of energy to the United States. And by integrating Canada into the US, Mr. Trump could get rid of the effects of foreign tariffs. He could secure Canada's resources and potentially create an economic giant that just dwarfs any other country. Now, actually doing this though is of course probably impossible because Canada is very independent with its own government, its own culture, and its own identity. But if you made it this far into the video, here's what I think about all of this and why I think it's really happening. I think Mr. Trump is just very clever, and what I think he's doing is a concept called anchoring. Now, anchoring is about presenting an extreme or outrageous demand at the start of a negotiation to set the tone, which shifts the perceived starting point. So when he says something outrageous, another country might say, "Do you want to buy us? Surely you can't be serious." And he's like, "I am serious, and don't call me Shirley." What this actually does is that it makes follow-up demands way more reasonable sounding, and lesser compromises will feel like a big win for the other party, even if the final agreement is still significantly favorable to the initiator. Now, Mr. Trump has actually done this before, and it's worked effectively. He did it, if you remember, when he told everyone that NAFTA was the worst trade deal ever. Remember those headlines? He said he would cancel the entire deal. Canada and Mexico freaked out, and he was able to make changes to that deal, which they otherwise would have never agreed to. In fact, this anchoring concept has been used to make some of the biggest deals throughout history. But as far as how this will affect all of our investments and retirement accounts, the big takeaway is this. This video was a 5,000-word essay, and tariffs are super complicated. Even though I can kind of understand what's going on, I don't think I'm smart enough to figure out all the complexity of how a specific tariff will affect which specific stock. Now, I can take a guess just like anyone else, but I'm not going to bet my money on it. That's why I keep it simple, and I dollar cost average into the stock market by buying an ETF, ticker symbol VTI, which gives me exposure to the entire market. That way, I'm not trying to pick winners and losers, because whether it's tech or consumer staples, this ETF has a piece of everything. And over the long term, as long as the US economy is growing, it's been a winning strategy. That and Bitcoin, but you already knew that. So I think Mr. Trump proposing these seemingly outlandish acquisitions like the Panama Canal and Canada and Greenland is just a way to anchor and reset expectations of putting America first. But with the real policies and what the real demands will be, time will tell. That's just my theory, but whether his ideas will actually happen though is something I'd love to hear from you. Let me know down in the comments below. As always, I hope you have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. I'd love to see you back here next week. Hope you had a wonderful new year. I'll see you soon. Bye-bye.
Attention is the ultimate asset. These social platforms have the attention. We're gonna now shop in that environment. That's gonna affect media, that's gonna affect retail, and that's gonna affect the product service industry. There's no shot that Meta, TikTok, YouTube, Google are not gonna be yelling and screaming about this. X will have this. This is too big, it's happened.
So what's a live event? Is this different than QVC shopping?
Not really.
Yeah.
I mean, it's really, you know, when this is the year, I mean, next year, this is gonna be a huge topic for everybody who watches this program, and you'll be talking about this. It really is QVC on social. Other than the way the algorithms work in social now, when a person or a company goes live, they're gonna find audiences. The algo's gonna bring it to you. So obviously, QVC, home shopping, that were in the 80s, the consumer had to click and go there. The fact that I'm going to be in my feed and then boom, there's a live shopping event and boom, the algo knows that I like t-shirts or vitamins or beauty and I get it, that's going to be a big factor.
Can I just say, like, you're going to have to sell me on the live events because I already buy a lot of stuff on Instagram where it's a pretty effective ad. It's flashy. It shows me how it works. The video makes me think, yeah, I want this. I don't know if I want somebody talking at me saying, hey, buy this product. You've got this much time to do that. You know, sell me on this. Why do I need something more than what's already selling me on Instagram?
Well, I don't really want to sell you. It's been sold, meaning there are unbelievable amounts of people making over $1 million a month already on TikTok live shopping. So it's not about, you know, convincing. It's about the conviction.
Those are vendors. Those are essentially companies selling.
No, they're influencers.
You're saying influencers are making $1 million a month?
Yes and yes, right? So
they have a product.
Yes, as well to that.
And hawking a product.
Yes, to that as well. This is going to be massive. Again, this is such a global platform. This has been going on for a decade in China. I've
watched the stuff in China.
Right? I've literally been waiting for 10 years for this. Like, there's videos of me in 2015 saying, this is coming.
It seems a little hokier than some of the flashy ads I already get that are
but
really
I think you'll
well
appreciate this. Some print, like, let's talk about it historically. What you're talking about is a print ad, in essence. Right. It just happens to be in
because
social.
The video
you mean video?
Fine. This is a live person.
Great.
Because it usually shows me something about the product I want.
That's video, so that's a commercial.
Yeah.
If it's an image, that's print. And all this is QVC. It works. I can speak for myself. I have a Pokemon-like brand called VFriends. We're doing live social shopping. I'm doing 7 hours, ironically, today about it.
You're going to be on for 7 hours?
I'm going to be on from 12 to 7 today on Whatnot, which is one of the platforms that's emerging. And 3 Mondays ago, we sold $40,000 worth of t-shirts in 2 hours.
Wow.
That if and we're good at this, did my best social media non-live shopping advertising, we would have sold $3,000 worth.
Okay. Well, I'm convinced by numbers like that.
Yeah.
We just did a shot from the mall in Paramus.
I saw.
Not a whole lot of people there. Is this why?
Well, it's 7:30 in the morning. Honestly, I was back there. I was like, that's a solid amount of people.
No, but we used to do, like, I've been doing this for a long time. It used to be the openings at 6 a.m. at 7 a.m. at 8 a.m.
Target
used to be insane. Break down the doors.
Is there an investor play on this? Is there a way? And this is changing retail, but is this taken away from Target? Does it take it away from Walmart?
I'm glad you brought this up. The reason I'm so excited to be here is every retail, every CPG. This is going to be over the next decade a consumer packaged good. So if you're Procter, if you're PepsiCo, I mean, this is going to be a major deal because don't forget, we have major channel conflict wars between the packaged good companies and the retailers. And the Amazons and the Walmarts are taking media dollars now away from social. The overall impact to consumable products and to retail of this dynamic and social shopping, and now the social networks taking an 8% rake on every transaction.
I heard 6 in some cases.
8%?
Some, but 8% and then a 3% process fee. But again, this is also going to hit Main Street. If you're a normal store in a small town in Jersey or California on Wednesday at 3 p.m., there is nothing going on. To your point, the retail traffic is changing. The fact that you can turn your little boutique into a studio now and go live shopping.
Entrepreneurs can do this too. If you're a small business owner, you can get right out there.
10 years ago, I used to go on this program and others and talk about influencers going to make money, and I got a little, and now it's a multi-billion-dollar economy.
Does it undermine
shopping
the big retailers? Does it undermine that?
Yeah, I would argue that live social shopping is the only potential thing that Amazon should be worrying about in their domination. That's how big this could be.
That's really amazing. And I guess the who this is disrupting is traditional media, who might have been pitching you these ads before.
Yes, but it's also going to disrupt retail. Like this is another, don't forget, attention ultimately is the ultimate asset. These social platforms have the attention. We're going to now shop in that environment. That's going to affect media, that's going to affect retail, and that's going to affect the product service industry.
Do the social media companies make money on this?
Yes.
So
again, they make 8%.
Good for Twitter and good for maybe some of these other companies.
There's no shot in 2025. I can't wait to come back in 6 to 12 months when this happens. There's no shot that Meta, TikTok, YouTube, Google are not going to be yelling and screaming about this. X will have this. This is too big. It's happened.
Who's the best at it so far?
TikTok. And it's not even
Tell
close.
us the name of an influencer or two that you think have made a ton of money from this or are leading this.
You know, it's funny.
And what do they do to be so in front?
So what I'm paying attention to more is the brand. So Mary Ruth Organics is a brand that's really doing this well. Sell? They're selling their vitamins. It's kind of a modern vitamin company. You saw, it was funny, I was talking to Mona and Dustin in the back. You showed the top 3 things that we're selling, right? T-shirts, vitamins, and beauty. And I looked at them and said, all 3 categories that are crushing right now on live social shopping. Abercrombie and Fitch. I don't know if you're paying attention that they're getting a reboot. And then there's also, I think you guys covered this on, I don't know if specifically you, but Chili's, the restaurant company, there was one TikTok, this is not live social shopping, this is just social. One TikTok that went viral that represented 40% of its Q3 growth. Wow. One TikTok that went viral. It was a triple cheese quesadilla. It wasn't even a limited time offer. Again, mango gummies, private label mango gummies from Walgreens, the ocean spray thing that was well covered.
Yeah.
I'm telling you.
We have to go, but I have to make a point.
Please.
Which is that one of the, what do you call it, postmortems on the election?
Yes.
Was that the Trump administration understood TikTok in a way that Biden, the Trump campaign in a way that Biden didn't. And I think what you're talking about now is investors need to understand it.
The battleground on social will impact every single stock on the market.
Cool. Well, thanks, Gary. Much appreciated. Always love Gary's stuff. What do you think? Let me know in the comments below. So there we go with this week's episode. What did you think? Leave me some comments below, please. Like and subscribe. As you can see, I'm pretty new here, so I could really use your help. So thank you so much. Take care of yourself. See you next week.